Hello everyone, this is Juan Sarmiento and today is Friday, June the 9th. We have one call expiring, which is in APA. Normally you can see that as an ITM or in the money sign here next to, for whatever reason it's not showing, but if you want to in your own platform, may application settings and look for positions and click on 1 week to expiration. That should be enough to show it. For whatever reason, it's not showing it here. But one other way is to click here and you would see all the options that are in our platform, in our account, and you can see that APA showing today, June the 9th, is expiring. So what are we going to do about that? Well, let's look at it. First, clicking on the APA and go to the Analyze tab, and here we have it. We can show all, and here we have it, the 34, and just so happens that it is going to expire out of the money, and that's why it's not showing. It's very, very close though. It's, if it was at 34.01, it would be showing us in the money. Okay, so what happens is this should go to zero today. So it has no value. We can look it up here clearly. Here on their positions, you see the 0, which implies it's expiring today, and the date, of course. And then we roll down until we see it here. 3 calls is our position, 0 days to expiration, 0 in extrinsic value, and extrinsic is 0.115. It should be 0, okay? By the time the day is up, it will be 0. So that's how much? Well, it's 0.115 times 100 is $11.05 times 3 is not, it's a certain amount of money. Huh? So if you want to close it, analyze closing, it will be 13 cents to pay for it. Okay, if I say analyze closing, 15 cents. I don't want to pay 15 cents to close this, do I? How much is that? $45. No, I don't want to pay $45. I'd rather let it expire worthless. Okay. But it may not, the stock may rally and then be worth some money. So we are going to sit here, wait 1 hour to expiration, and then see what they're going to do. One possibility is to roll over the call. So if I say analyze rolling, over here, sorry, analyze rolling, and this is what we could get. Let me delete all of this so I don't get confused. We can repopulate this as we need to. So this will be the rolling, and obviously if we go to June 16th, that's just 1 week. You can do that, but you're not going to get much value out of that. So let's say 30 days, well, we have 28 and 35. So let's try those two. First, let's say we roll it to July 7th. And I get $1.32. If I roll it to July 14th, we get 152, we get 20 cents more. But it's times 3 times 100, so it's not just anything, it's money. Okay, so, which one of the two should I do? Well, it depends on the extrinsic value, if it is worth it. How do I know it's worth it? We're gonna get into that. So let's click here on the, for this, the June is only 77 cents. Okay, so we decided we're gonna do 28 days or 35 days. Right here you see the extrinsic value of this. The 34 is we only have extrinsic value right now. So let's click on the bid. We're going to get $1.46. If I look at the risk graph, delete everything else, let's just focus on this option, and let's say 3. Well, here is how much we're going to get, $438. Is that worth it? I say, well, if for every 100 points or dollars you get $350, that's not good. But if you get 500, that's better. So 432 is good, not excellent. Okay, so what if we did the July 14 rather, that you get a little more, you get exactly $492. Okay, so that's close to 500. I'm almost willing to do that. Let's look at our covered call calculation here. So let's enter the stock price here. 34 is now 33.84. Our option extrinsic value is 164. I know that because an option that is out of the money has no intrinsic value, so it's 1.64. But you can look it up just to verify. Look at the chart right over here. The 14th, 165, 163, the extrinsic value is 165. Okay, well, let's put 165. Look at, this is the extrinsic value and this is the bid and ask. Okay, so thereabouts, all right, somewhere in there. So 165, let's say we got that price. And then how many options we have? 3. Okay, so we multiply the option value, the extrinsic value, 165 times 300, and that gives us 495. Okay, but what if it was 100? If it was $100 a share, it would be $487. Okay, so we're getting good price for that. Okay, I'd like to see it at 500, but let's say we already made some money, we want to keep it going, so to speak. You can do that. All right, so let's do that. Unfortunately, the option that we would buy, this one here, let me just delete everything else. That's the option we would be selling. If I were to close this, I would have to pay 15 cents. So that's going to be taken away from this. Well, we can sit here and wait, or we can make our price 1.63. Okay, so let's come over here and say analyze. No, we want to roll it. Analyze rolling. And here it is. We are going to buy back the June, and we're going to say sell the July 14th. That's 1.52. Okay, so this value is increasing as we speak, but the value of the option call here is also increasing. Well, if I enter the trade and check it out in a few hours when we're closer to expiration, perhaps we could buy that back for 2 cents instead of 19. So I'm going to put here 165 or 69 even. 69, subtract 2, let's put 67. It's increasing as we speak. 67. I'm going to put 68. So we pay 2 cents for the option we are going to close. Okay, so what does that look like? Well, is it worth it? Well, let's see first what we have currently. Okay, you need to say 0 here. Okay, this is our current position. Expiration, let's say 1 to expiration. Okay, here we are right here. You see that the magenta line is telling us what the price is currently. what our profit is currently. But the blue line tells us what the profit will be at expiration, which is only a couple of hours away. And here you have it. If I select that, okay, right now I have 604. If I wait, it will be 672 or thereabouts. So obviously these things are not exact, but there's a difference of $60 that I would leaving on the table if I were to close the position right now. Okay. What if I did this rollover? Normally when you show 2 to expiration, it will show you 1/3 line, which will be at the expiration in July. It's not showing me that. But I can scroll over here, and this will be how much I'm getting. 1174, 1,174. That is the combination of the first trade and the second, the rollover trade. Okay, so in 2 months, I have already, hopefully, make $1,173. Okay, so we could set the trade, but I would recommend wait closer to expiration so that your option that you are rolling over to, right now we are 34. See? So guess what? The monitor, let's go here, close this, and now I should be getting in the money sign. There it is, because we're now more than 34. Okay, so now the option that I'm selling has some intrinsic value. Let's go over here, let's look at July, and you see that it has a 4 cents intrinsic value. Meanwhile, the option that we are buying back has 22 extrinsic value. Intrinsic only 1 penny. You see that? So this 22 should be 0. Okay, so you might wait. Let's say the stock rally 1 point, well then we can roll it over to the 35 strike price. You would have to see what the price is right there. Okay, so I'd say, well, let's just do this, and that will be 170. I would say I would place the trade as is, and if it doesn't get filled 1 hour before expiration, I can go and reevaluate. Because I don't have the time, I'm just going to do it. And hopefully we'll get assigned. Look at the credit, $510. This is ideal because the stock is exactly at my expiration. You're not always going to get that. And I hopefully in the next sessions, when we have other guys expiring, they might be expiring higher or lower than the strike price, and we are going to deal with those in due time. This is the most interesting one because you have that price so very close. Okay, but when the option is higher, well, when the stock is at a higher strike price, at a higher price, then we can close the option that we are having with 0 extrinsic value, only intrinsic value, and sell another one at a higher price with higher intrinsic value, with higher extrinsic value. Okay. What you're looking for is no intrinsic value when you are selling a new option. Okay. No intrinsic, only extrinsic, the maximum possible, because that's the value you're going to get to keep. Interestingly, here we are. Let's go check out our monitor tab, account statement, and you'd remember, when was the first time we enter a trade here? Well, the APA was entered on May the 12th. We have others that were really close. Let's see, Marvel. When did we enter that one? That option simply expired. And that was entered on, You see April the 28th. So this is pretty much when we started in April, this strategy. And let me enter, the other one was USB, I believe. Yes, USB. When did we enter that? May the 3rd. So my first trade was Marvel, okay? And you can see that now that it says 0, 0, 0 margin requirement, 0, 0, everything. That's because it's now removed. I decided to let be taken away. The stock jumped very much. You remember that. Okay, so after 1 month and a bit, over a month, we have in profits for this IRA, we have $4,000. Okay, so you can grab the calculator, and we have $4,000. And how much did we invest? 100,000 times 100, that gives us 4% in 1 month. Okay, I'm not saying this is always going to happen. I'm just saying I'm showing you something interesting and productive. Obviously, if we are picking the stock when they're at the bottom, they tend to jump and give us the results we want. So let's multiply that. 4% times 12, that will give you almost 50% return in 1 year. Well, yeah, that would be ultra nice, wouldn't it? So let's see, as we do this form of trading, how much we get in the end. It requires a lot of attention. You know, it requires you to watch this pretty much every day. Okay, so now that is the IRA account in which we had $100,000 and we have invested. We still have plenty of value here, 31. You can do 3 more trades and still be fine. We'll do that next week and the weeks to come. Okay, I've been putting pretty much 1 or 2 per week. All right, so what happens to the IRA with a margin account? Well, in the margin account, is more or less the same value because I have entered those trades almost simultaneously. So 4,000, okay, but this time out of a $50,000 account. Well, then that means we have even larger profit in terms of percent. 4,000 divided by 50,000 gives us 8% times 12, we could get to 100%, 96%. Wouldn't that be nice? Well, I'm not saying it's going to happen, but you know, if something less than that happens, I'm happy. I like this strategy because we started pretty much when all these stocks were bottoming, and that's why they had their volatility pretty high. Let's say APA, well, it's been pretty much moving sideways for all this time, and now it's picking up. But that's all I care about, that it maintains its price or goes higher. Look at all the trades we have made. They were pretty much at the bottom at the time they were having the high volatility. They were at the bottom, and now they bounce back, and bingo. Even something like Micron Technologies, it was high, it's come down, and we still are making good progress on that, even though it's barely making any money. Right there you have this bar. It shows you where you make the money and where you are. It's been a loser so far, but I think that's about to change. Even if it didn't do anything from here, if it stays where it is, it will give us some money. But I would like to see what happens when this option expires out of the money, below the price. What are we going to do? Well, I'm going to show you in the weeks to come. So be sure to stick around with me in the weeks to come, because I think we have something nice that you could trade in your own accounts. So thank you very much for joining me, and see you next time. Bye-bye.